Hello. So this is a new series that I'm going to be doing, just to maybe expose you to more of of the reading and stuff like that. That kind of challenges the way that I think, and hopefully it will give you a little bit of insight into what are some of the great minds have to say about investing and things like that. I actually realized after I recorded all this that I didn't record myself through this, so this is just me to say hi. I'm here. So it's just my voice and the screen. But basically, this is just a paper that was written and released. They release them pretty often, but there's a few notable figures that release these type of papers, and they often have interesting thoughts, interesting things to say, but mainly on the topic of investing. Not really the personal finance so much, but investing very specifically, and maybe it will challenge you. It is long, so I don't expect you to watch it all by any means. But the link is in the description for the um for the paper, for his memo. And I would love to know your thoughts if you have any thoughts or anything like that. But anyway, this is just my thoughts, and I think going forwards, instead of me just reading them in my own space on my couch, I might do a little bit more of this, where maybe I can explain some key concepts, and it will just improve the way you think about investing, and just to see what some of the great minds out there are thinking. But anyway, love to hear your feedback. Now we can head over to past me, to go over the material. Bye. Hey, so this is a newer series I'm gonna do. This isn't for everybody. I know a lot of people won't want to watch this. So, but basically, I do a lot of reading, of course. I get a lot of information across my desk, and this was one in particular that I started reading, and I was like, this would be a great thing to share. If anybody's looking for more information on how, even me as an advisor, likes to challenge themselves, I guess. So this is a memo from Howard Marks. He's a pretty big, like, private equity, like distressed equity type manager, in the US. It's very, very rich, pretty successful at what he does. But he made a memo, and this is some of the things that he I guess he wanted to say. So he put it down in a written format. We're not going to go through all of it because it is very long, but the link will be in the description. There's also an audio version of it if you would rather that. That's about an hour long. But anyway, is entitled "What Really Matters," and it was based on the premise that we as investors, as advisors, as fund managers, pretty much as humans, tend to, when it comes to investing, tend to focus on things that may make us feel better to worry about, but don't actually make a large impact in the long term. And to keep in mind here, Howard is he's an active manager. That's what he does. That's how he makes his money. And even some of the stuff he says in here will make you understand why. But yes, let's get into it. So the first thing that he talks about here is short-term events. And honestly, I'm just gonna read part of this. Okay, so in the illusion of knowledge, I rallied against macro forecasting, which in our profession mostly concerns the next year or two. So macro are big events that can affect the markets as a whole. Things like COVID, things like interest rates going up. These are all macro events that will affect, will have a large impact. So I discussed these questions I was most frequently asked at the conference in London. How bad will inflation get? How much will the Fed raise interest rates to fight it? Will those increases cause a recession? How bad will the recession be and for how long? The bottom line I told the attendees was that these things all relate to the short term, and this is what I know about the short term. A. Most investors can't do a superior job of predicting short-term phenomena like these. Second, thus, they shouldn't put stock in opinions on these subjects, theirs or those of others. Basically, don't make decisions based on what you suspect about short-term happenings, I guess, in the markets. Second one here, they're unlikely to make changes in their portfolios in response to these. These are the smart ones. And the changes they do make are unlikely to be consistently right. Thus, these aren't the things that matter. So he goes on to talk about examples. So, for example, in response to the first tremors of the global financial crisis, the Fed began to cut the Federal Reserve rate, federal fund rate, in Q3 2007. They then lowered it to zero around the end of 2008 and left it there for 7 years. In late 2015, the only question I got was, when will the first rate increase occur? My answer was always the same. Why do you care? If I say February, what will you do? If I later change my mind and say May, what will you do differently? If everyone knows rates are about to rise, what difference does it make which month the process starts? No one ever offered a convincing answer. Investors probably think asking such questions is part of behaving professionally, but I doubt they could explain why. The vast majority of investors can't know for sure what macro events lie just ahead or how the markets will react to the things that do happen. In The Illusion of Knowledge, I wrote at length that the way unforeseen events make a hash of economic and blah blah. In The Illusion of Knowledge, I wrote at length about the way unforeseen events make a hash of economic and market forecasts. In summary, most forecasts are, I don't even know what that says, extrapolations. I don't know what that means. Action of estimating or concluding something by assuming that existing trends will continue or current method will remain applicable. Okay. In summary, most forecasts are whatever that's, and most of the time things don't change. So extrapolations are usually correct, but not particularly profitable. On the other hand, accurate forecasts of deviations from trends can be very profitable, but they are hard to make and hard to act on. These are some of the reasons why most people can't predict the future well enough to repeatedly produce superior performance. This goes in line with what's his name, Michael Burry or whatever, that did the famous 2000. There's that movie about him, the 2008 short. The cost of him to act on those actions was insane, and he is rated as like this really good manager. He's got a ton of publicity now, and that's kind of what he lives on. But the fact he made that trade was insane. That to risk clients' money like that on something that if it had lasted like a month or two longer or whatever, he'd have ran out of money, spent all the money, and had nothing to show for it, is wild. So even if you do make these type of forecasts and you want to make actions on it, sometimes it's just not worth it. It's just not worth the risk, especially when you know it's going to be like a macro event that's going to affect everybody, right? Like what if what you think doesn't happen? Like the downside is just so great. But anyway, why is doing this so hard? Most of us know that events are likely to transpire. Can't we just buy the securities of the companies that are most likely to benefit from those events? In the long run, maybe, but I want to turn to a theme that Bruce Karsh has been emphasizing lately, regarding a major reason why it's particularly challenging to profit from a short-term focus. It's very difficult to know which expectations regarding events are already incorporated into security prices. This is referred to as some of this is the efficient market hypothesis. So it's a theory that pretty much holds true, but it's almost impossible to prove, and there's a lot of it's impossible to disprove either. It's kind of but basically it says that the stock market processes events and spits out a fair price very rapidly, and we call that something already being priced in. So the only times we will see big movements, for instance, is if it goes against expectations. So a good example right now is inflation report. If the markets are already pricing in, 10% inflation, then and inflation is 10%, guess what? The markets aren't going to move much because it's already been priced in. Because it's already been present. If, however, there's a surprise, well, then that's a little bit different. Then you tend to see swings. One of the most crucial mistakes people are guilty of, we see it all the time in the media, is believing that changes in security prices are the result of events, that favorable events lead to rising prices and negative events lead to falling prices. This isn't true, and I'm assuming. No, keep reading. I think that's what most people believe, especially first-level thinkers, but that's not right. Security prices are determined by events and how investors react to those events, which is largely a function of how the events stack up against investors' expectations. I cannot stress this enough, that short-term prices movement is all about expectations. And it, like as I said, I said this I sent out an email a while ago, talking about the unpredictability of the current environment, and the time to be worried about the stock market being so volatile and going up and down is when there is no concern, I guess. Like there's no worry, there's no unknown. If that ever happens, then it's to be worried. But while there's unknown, while there's uncertainty, that's what causes swings. Is uncertainty, is the unknown. And when things don't go according to plan or what people expect, well, then we get the swings on news. Other than that, the swings happen way before the news is announced. If the market is expecting a rate increase, then it's priced in as soon as that rate increase is thought to be a potential. It doesn't wait until the day of to drop 5%. That happens beforehand, and you can see that if you go take a look at the rate increase cycle that we've already been through, you'll see that these drops in the market, the movements happen before it's announced. And it won't change all that much when it is announced if it's within expectations. So keep reading this article's long. Okay, how can we explain the company that reports high earnings only to see its stock price drop? Of course, the answer, of course, is that the reported improvement fell short of expectations and thus disappointed investors. So, at the most elementary level, it's not whether the event is simply positive or not, but how the event compares to what was expected. That's what it said. In my earliest working years, I used to spend a few minutes each day looking over the earnings report printed in the Wall Street Journal. But after a while, it dawned on me that since I didn't know what numbers had been expected, I had no idea whether an announcement from a company I didn't follow was good or bad news. Investors can become expert regarding a few companies and their securities, but no one is likely to know enough about macro events, A, to be able to understand the macro expectations that underlie the price of securities, B, anticipate the broad events, and C, predict how those securities will react. Where can a prospective buyer look to find out what the investors who set security prices already anticipate in terms of inflation, GDP, or unemployment? Inferences regarding expectations can sometimes be drawn from asset prices, but the inferred levels often aren't proved correct when the actual results come in. So basically, that the people who set so the market, you can see what they're anticipating, which is how we do it, through what is priced into the market. Is basically what it's saying. That's where you would go to see what the consensus is. Further, in the short term, security prices are highly susceptible to random and exogenous, the words it uses in this, events that can swamp the impact of fundamental events. Macro events and the ups and downs of companies' near-term fortunes are unpredictable and not necessarily indicative or relevant to companies' long-term prospects, so little attention should be paid to them. Enough said. For example, companies often deliberately reduce current earnings by investing in the future of their business. Thus, low reported earnings can imply high future earnings, not continued low earnings. To know the difference, you have to have an in-depth understanding of the company. This is where it gets to buying companies versus pieces of paper or numbers on a screen. But seeing this type of investor he is, I'm sure he goes into that somewhere. Okay, no one should be fooled into thinking security pricing is a dependable process that accurately follows a set of rules. Events are unpredictable. They can be altered by unpredictable influences, and investors' reactions to the events that occur are unpredictable. Due to the presence of so much uncertainty, most investors are unable to improve their results by focusing on the short term. So, I mean, theoretically, it's possible, right? Like, and I think that's what a lot of people hold on to. Theoretically, it's possible to use the short term macro events to create alpha or create an excess return. It's just proved nearly impossible to do. It's not worth over the long term. I don't think I've never heard of anybody being able to do it, and it's just not worth. I guess you're flipping a coin, like almost more than flipping a coin. You're like, that's playing. You might as well go to Vegas. Like at that point, you just to try to invest that way, the odds are so low of you succeeding that I mean, most managers don't do that. Like try to do short term trade macro events. Like at least good ones don't. Anyway, it's clear from observation that security prices fluctuate much more than economic output or company profits. What accounts for this? It must be the fact that in the short term, the ups and downs of prices are influenced far more by swings in investor psychology than by changes in companies' long-term prospects. Absolutely. Because swings in psychology matter more in the near term than changes in fundamentals and are so hard to predict. Most short-term trading is a waste of time, or worse, people lose money. Yeah, so that's the first one. What was that? That was short-term events don't matter. Okay, the trading mentality. Over the years, my memos have often included some of my father's jokes about the 1950s, based on my strong belief that humor often reflects truths about the human condition. Given its relevance here, I'm going to devote a bit of space to a joke I've shared before. Two friends meet in the street, and Joe asks Sam what's new. Oh, he replies, I just got a case of great sardines. Great, I love sardines. Let's take some. How much are they? $10,000 a tin. What? How can a tin of sardines cost $10,000? These are the greatest sardines in the world. Each one is a pedigreed purebred with papers. They were caught by net, not hook, deboned by hand, and packed into the finest extra virgin olive oil, and the label was painted by a well-known artist. They're a bargain at $10,000. But who would ever eat $10,000 sardines? Oh, these aren't eating sardines, they're trading sardines. Wow, I feel like a nerd. I include this old joke because I believe most people treat stocks and bonds like something to trade, not something to own. If you ask Warren Buffett to describe the foundation of his approach to investing, he'll probably start by insisting that stocks should be thought of as an ownership interest in companies. Most people don't start companies with the goal of selling them in the short term, but rather they seek to operate them, enjoy profitability, and expand the business. Of course, founders do these things to ultimately make money. They are likely to view the money as the byproduct of having run a successful business. Buffett says people who buy stocks should think of themselves as partners of owners with whom they share goals. This is a big difference. Like getting into the fight between active and passive management. You'll notice the best investors in the world are not managing a US equity fund. Or they're not managing a Canadian dividend fund. Like, they are investors who own businesses who, like, Warren Buffett's a good example. Yes, he has bought stocks on the stock market, but have you seen how much he buys? Like, he is buying a significant portion of these businesses, enough to influence the businesses, and to be heard, to sit at the table. So yes, they are publicly traded, and there's plenty of non-publicly traded businesses. He also is in the insurance industry, and it's fun. Like, he is not out there trying to pick best performers over the next few years. Like, he is buying large chunks of these businesses, and yeah, sometimes he gets lucky with performance. Apple, for instance, but he won't. They're not going to sell Apple now that it like they're not going to get out of Apple completely now that it went up when they bought it. But it's an example, I guess. That's very different than like a fund manager who's picking 30 companies that he thinks are going to outperform the market. Warren Buffett isn't trying to outperform the market, and the good hedge fund like managers aren't trying to, investors aren't trying to outperform the market. They're trying to pick really good companies that have really good prospects, and part of the byproduct of that might be that they outperform the market, unless they don't outperform the market. So yeah, this doesn't matter. Okay, anyway, but I think that's rarely the case. Most people buy stocks with the goal of selling them at a higher price, thinking they're for trading, not for owning. This means they abandon their owner mentality and instead act like gamblers or spectators who bet on stock price moves. The results are often unpleasant. The Dalbar Institute of 2012 study showed that investors received 3 percentage points less per year than the S&P 500 generated from 1992 to 2012. The average holding period for a typical investor is 6 months. 6 months. When you hold a stock for less than a year, you're not using the stock market to acquire business ownership positions and participate in the growth of that business. Instead, you're just guessing at short-term news and expectations, and your returns are based on how other people react to that news information. In aggregate, that kind of attitude gets you 3 percentage points less per year than you'd get from doing nothing at all beyond making the initial investment in the index fund of the S&P 500. To me, buying for short-term trade equities buying for short-term trade equates to forgetting about your sports team's chances of winning the championship and instead betting on who's going to succeed in the next play, period, or inning. Let's think about the logic. You buy a stock because you think it's worth more than you have to pay for it, whereas the seller considers it fully priced. Someday, if things go well, it will become fully priced, in your opinion, meaning you'll sell it. The person you sell it to, however, will buy it because he thinks it's worth more still. We used to talk about this process as being reliant on the greater fool theory. No matter what price I pay for a stock, there will always be someone who will buy it from me for more, despite the fact that I'm selling because I've concluded that it has reached its full value. I mean, there's other reasons people sell stock, but yeah, as an investor, like if you're, I think on a bigger picture. Okay, every buyer is motivated by the belief that the stock will eventually be worth more than today's price, a view the seller presumably doesn't share. The key question is what type of thinking underlines these purchases. Are the buyers buying because it's a company that they'd like to own a piece of for years, or are they merely betting that the price will go up? The transactions may look the same from the outside, but I wonder about the thought process and thus the soundness of logic. Each time a stock is traded, one side is wrong and one side is right. But if what you're doing is betting on trends in popularity and thus the direction of price moves over the next month, quarter, or year, is it realistic to believe you'll be right more often than the person on the other side of the trade? Maybe the decline of active management can be attributed to the many active managers who placed bets on the direction of stock prices in the short term instead of picking companies they wanted to own part of for years. It's all a matter of the underlying mentality. I had a long debate on this topic with my father back in 1969, when I lived with him during my first months at First National Citibank. It's amazing for me to think back to those days. He was so much younger than I am today. I told him I thought buying a stock should be motivated by something other than the hope the price would rise, and I suggested this might be the expectation that dividends would increase over time. He countered that no one buys stocks for the dividends. They buy because they think the price will go up. But what would trigger the rise? Wanting to own a business for its commercial merit and long-term earnings potential is a good reason to be a stockholder, and if these expectations are borne out, a good reason to believe the stock price will rise. In the absence of that, buying in the hope of appreciation merely amounts to trying to guess which industries and companies investors will favor in the future. Ben Graham famously said, "In the short run, the market is a voting machine, but in the long run, it is a weighing machine." This is a quote that everybody's taught in school, and it's an important one, and one that I that's a big reason why I hate risk and the way it's done is because honestly, risk tolerance comes a lot from education. The more educated you are on investing and investments, the more comfortable you are with volatility and with risk. Okay, really game. In the short run, the market is a voting machine, but in the long run, it is a weighing machine. While none of this is easy, as Charlie Munger once told me, he works with Warren Buffett. Carefully weighing long-term merit should produce better results than trying to guess at short-term swings in popularity. Basically, he's basically saying that if you make a good decision if you make decisions based on sound reasoning, you will be right more than if you make them based on in this case, it's gambling. You're just hoping that prices go up and you can sell it to somebody else. Which is why when I talk about buying individual stocks, it really comes down to the like why you're buying it, I guess, and whether that's an investment or if it's a gamble. Because if you can't, have a good case and this isn't a company that you have faith in, you want it to grow and you think it has good prospects, well then you're buying it as a gamble. If you're just buying it because your friend told you to and you just hope it goes up, or because even if you just heard about the company, you like the company, it's still a gamble. If you don't know, if you can't tell me what you think it's worth, and you can't speak to its growth trajectory, and it's gambling to some extent. Obviously some gambles are riskier than others. Okay, what doesn't matter? Short-term performance. Given the possible contributors to short-term investment performance, reported results can present a highly misleading picture. And here I'm talking mostly about superior gains in good times. I feel there are 3 ingredients for success during good times: aggressiveness, timing, and skill. And if you have enough aggressiveness at the right time, you don't need that much skill. We all know that in good times, the highest returns often go to the person whose portfolio incorporates the most risk, beta, and correlation. Should I go into that? Risk is measured in volatility. Beta is to do with the market overall. So if the market's up 10% and the investment's up 10%, then it's like a beta of 1. It's par. If the investment's up 10% and the manager is up 8%, the beta is at 0.8, basically. Correlation is just how two things move in unison. So let's say the stock market goes up steadily 5% and another investment goes up steadily 5%, then it has a high correlation to the stock market in general. Okay, having such a portfolio isn't a mark of distinction or insight if the investor is a perma-bull who's always positioned aggressively. Finally, random events can have an overwhelming impact on returns in either direction in a given quarter or year. One of the recurring themes in my memos is the idea that the quality of a decision cannot be determined by the outcome alone. I really like that. It's nice. Okay, decisions often lead to negative outcomes even when they're well reasoned and based on all the available information. On the other hand, we all know people, even occasionally ourselves, who've been right for the wrong reasons. Hidden information and a random development can frustrate even the best thinkers' decisions. However, when outcomes are considered over the long term, a long period of time, and a large number of trials, the better decision maker is overwhelmingly likely to have a higher proportion of success. I've never seen it put like that, but I love this. This is I mean, not even just for investing, but for just personal finance in general. A lot of people get really lucky, but to base your decisions on that, it's much better that you base your decisions on sound reasoning, because you're going to be right more often, and more often means that you have a better chance in the long run of being successful, or whatever that success means to you. So in in this sense. Investing, he's likening it to investing here, but I think it carries on to a pretty much every part of life, really. Okay. Obviously, no one should attach much significance to returns in one quarter or year. Investment performance is simply one result drawn from the full range of returns that could have materialized, and in the short term, it can be heavily influenced by random events. Thus, a single quarter's return is likely to be a very weak indicator of an investor's ability, if that. Deciding whether a manager has a special skill or whether an asset allocation is appropriate for the long term on the basis of one quarter or year is like forming an opinion of a baseball player on the basis of one trip to the plate, or a racehorse based on one race. We know short-term performance doesn't matter, and yet most of the investment committees I've sat on have had the latest quarter's performance on the first item on the agenda and devoted a meaningful portion of each meeting to it. The discussion is usually extensive, but it rarely leads to significant action. So why do we keep doing it? For the same reasons investors pay attention to forecasting, as described in The Illusion of Knowledge. Everybody does it, and it would be irresponsible not to. It's right. Like, I do it, right? Like I still look at short-term performance when I'm looking at the investments and the portfolio managers and stuff that I use. I still, to some degree, like I try not to make decisions on hiring or firing a fund manager or going passive or whatever on an investment decision based on short-term performance, but it's definitely something I look at. And why do you look at it? You look at it because people are going to ask you about it, right? Like it's part of, almost part of being responsible for somebody else's money. It's like you have to look at it and ideally help them make a good decision as to what to do relative to this short-term performance. But for the vast majority of the time, it makes no difference long term. Similar to COVID, like COVID's not gonna, in 20 years it's not gonna matter. But yeah, it's something that despite, we still, even investment reports, we still print 3-month returns as if they have any bearing on the underlying holdings. I'm pretty sure we have to, so I don't know if that's just I don't think it's something that I would ever be able to get away from. It's just another hurdle, I guess, to teaching how to be a good disciplined investor. So anyway, what doesn't matter? Volatility. I haven't read much about volatility, other than to say I strongly disagree with people who consider it the definition or essence of risk. Thank you. I've described my belief that the academics who developed the Chicago School theory of investment in the early 60s wanted to examine the relationship between investment returns and risk, needed a number quantifying risk that they could put into their calculations, and undoubtedly chose volatility as a proxy for risk for the simple reason that it was the only quantifiable metric available. It's pretty much. I define risk as a probability of a bad outcome. You know what the worst thing is? So that is how 99% of people define risk until you're talking about investments. And then suddenly the client doesn't change. Like, the client still views that we're talking about, that's what we're talking about as risk. So when you're like, oh, this is a medium high risk mutual fund, they're thinking, oh, that means there's a medium high chance of a bad outcome. But it's not. That's not what they're talking about. They're talking about how much it moves up and down and how much it's likely to move up and down, which is not the same. Like, just because something moves up and down more, it doesn't mean it's inherently more risky than something that doesn't. And people also assume bonds are less risky than stocks. It's like, well, what would you rather own? You'd rather own RBC bank stock, which pays a nice dividend, or would you rather own some tech company bond in the middle of Algeria? It's just, I don't know. The Algerian bond might not move until it goes to zero, and then you lost all your money. Versus, RBC, which is going to move every single day and could be considered a medium risk stock. Volatility is dumb. But anyway, I define risk as the probability of a bad outcome, and volatility is, at best, an indicator of the presence of risk. But volatility is not risk. That's all I'm going to say on the subject. But I want to talk about what I want to talk about here is the extent to which thinking and caring about volatility has warped the investing world over the 50 plus years I've been in it. It was a great advantage for me to have attended the Graduate School of Business at the University of Chicago in the late 60s and to have been part of one of the very first classes that taught the new theories. I learned about the efficient market hypothesis. I mentioned that earlier. That's all information, like the markets are efficient with information, so it's very difficult. Well, the efficient market hypothesis says that you can't, that prices are fairly are fair to whatever's going on, so it's very difficult to identify underpriced securities. In reality, though, it's possible to do. We've seen people do it. In practice, it's seldom something that we should strive to do. If that's the reason that you're buying or picking a manager or buying a fund is to outperform the market somehow, it's kind of like a fool's errand, really. And there's plenty of data to back that up. Capital asset pricing model, that's how you can evaluate a stock, or how people evaluate stocks. There's actually there's a few different pricing models that people use. The random walk, that's basically just future, like past stock movements don't predict future stock movements. Basically that theory. It's random, so you can't, base what happened in the past in a stock movement to what's going to happen in the future. The importance of risk aversion and the role of volatility as risk. While volatility wasn't a topic in conversation when I got into the real world of investing in 1969, practice soon caught up with theory. In particular, the Sharpe ratio was adopted as the measure of risk-adjusted returns. This is something that you'll very seldom ever see, but it's it's the ratio of a portfolio's excess return, the part of its return that exceeds the yield on T-bills, to its volatility. Now, you don't really have to worry about this part. It's basically the return compared to the volatility. The more return per unit of volatility, the higher the risk-adjusted return. The risk adjustment is an essential concept, and return should absolutely be evaluated relative to the risk that was taken to achieve them. Everybody cites Sharpe ratios, including Oaktree as the firm that he is, because it's the only quantifiable tool available for the job. If investors, consultants, and clients didn't use a Sharpe ratio, they'd have no metric at all. And if they tried to substitute fundamental riskiness for volatility in their assessments, they'd find that there's no way to quantify it. So this is where, when I say like you shouldn't invest in like a mutual fund just to try to outperform the market, because that's a fool's errand. This is a reason that fund managers have, and there's a lot of evidence showing that they've done a pretty good job with, and that's reducing volatility and increasing risk-adjusted returns. So getting more return per unit of risk, and some managers have been very, very successful with that. So that means basically you get a higher return per fluctuation, per unit of volatility, and that's why they use it, because risk is very difficult to quantify. In fact, this is the only way that we have to do that, so that's how they do it. It's just because it's the only one doesn't mean it's a good one. The Sharpe ratio may hint at risk-adjusted performance in the same way that volatility hints at risk, but since volatility isn't risk, the Sharpe ratio is a very imperfect measure. Take, for example, this is real long. Take, for example, one of the asset classes I started working with in 78, high-yield bonds. At Oaktree, we think moderately above benchmark returns can be produced with substantially less risk than the benchmark, and this shows up in superior Sharpe ratios. So again, he's now talking risk as volatility. But the real risk in high-yield bonds, the one we care about and have a history of reducing, is the risk of default. The probability of something really bad happening. That's risk. We don't much care about reducing volatility, and we don't take conscious steps to do so. We believe high Sharpe ratios can result from, and perhaps are correlated with, the actions we take to reduce defaults. Again, they're focusing on, this is what any good bond manager, any good fund manager, any good investor will focus on, and that is minimizing the actual risk, like the risk of forget macro events. If the markets are down 10% and your portfolio is down 10%, you're down 10%. What you're trying to avoid is nothing macro event, no macro event going on, and your portfolio is still down, right? Like, because the company itself is failing, is doing a Toys R Us, like, and going to be going bankrupt. That's the type of risk that you really need to be trying to mitigate. Like, volatility is volatility. Like, the less you can be bothered by it, the better of an investor you'll be, and the better you'll sleep at night as well. Okay. Volatility is particularly irrelevant in our field of fixed income or credit. Bonds, notes, and loans represent contractual promises of the periodic interest and repayment at maturity. Most of the time when you buy a bond with an 8% yield, you'll basically get the 8% yield over its life, regardless of whether the bond price goes up or down in the interim. I say basically because if the price falls, you have the opportunity to reinvest the interest payments at yields above 8%, so your holding period will soon creep up. Thus, the downward price volatility that so many revile is actually a good thing, as long as it doesn't precede defaults. Note that, as indicated in this paragraph, volatility is often a misnomer. Strategists and the media often warn that there may be volatility ahead. What they really mean is there may be price declines ahead. No one worries about or minds experiencing volatility to the upside. it's true. Grab some. It is It is essential to recognize that protection from volatility generally isn't a free good. Reducing volatility for its own sake is a sub-optimizing strategy. It should be presumed that favoring lower volatility assets and approaches will, all things being equal, lead to lower returns. Simple as that. You just see that across investing. So the higher volatility, but that does get to a point, I guess, where you're almost taking on that volatility for no real benefit. So there's a balance to be had, but certainly something with very low volatility is very likely to return very low returns. That's just the nature of risk versus reward. If you want more reward, you have to take on more risk. Okay. Nevertheless, since many clients, bosses, and other constituents are uncomfortable with radical ups and downs, well, mostly with downs, yeah, asset managers often take steps to reduce volatility. Consider what happened after institutional investors began to pile into hedge funds following the 3-year decline of stocks brought on by the bursting of the tech bubble in 2000. This was the first 3-year decline since 1941. Hedge funds, previously members of a cottage industry where most funds had a few $100 million of capital from wealthy individuals, did much better than stocks in the downdraft. Institutions were attracted to these funds' low volatility and thus invested billions in them. The average hedge fund delivered the stability the institutions wanted, but somewhere in the shuffle, the idea of earning high returns with low volatility got lost. Instead, hedge fund managers pursued low volatility as a goal in itself, and since they knew it was what the institutions were after, As a result, over roughly the last 18 years, the average hedge fund delivered the low volatility that was desired, but it was accompanied by modest single-digit returns. No miracle there. Why do I recite all this? Because volatility is just a temporary phenomenon, assuming you survive it financially, and most investors shouldn't attach as much importance to it as they seem to. This is where planning comes into play, right? Like, this guy's on the investing side, only really cares about investing. So somebody like CVP Canada would invest this way, right? Where you completely ignore volatility. In practice, though, for us, it doesn't work that way. Especially when it comes to growth side, it does to a degree. But when it comes to retirement and pulling money out of a portfolio, volatility matters. And that's where good planning comes into play, because this part, assuming you will survive it financially, is about all that matters to when you're in your retirement, you're relying on these funds for an income. So yeah, when you're in a point in your life where you're earning an income from some other source, volatility shouldn't matter. When you're in your point where you're earning it from the investment portfolio, volatility will happen. And when I say volatility, like, down markets will happen, market crashes will happen, market corrections will happen, 20% down will happen. But making sure you're planned and that your portfolio is appropriate for that, to get you through that, and to give it the time it needs to recover, you can't really put a price tag on that. That can make or break somebody's retirement. Okay, anyway. As I wrote in I Beg to Differ, many investors have the luxury of being able to focus exclusively on the long term, if they'll take advantage of it. Volatility should be less of a concern for investors whose entities are long-lived, like life insurance companies, endowments, and pension funds, whose capital isn't subject to lump sum withdrawal, whose essential activities won't be jeopardized by downward fluctuations, who don't have to worry about being forced into mistakes by their constituents, and who haven't levered up with debt that might have to be repaid in the short term. Okay, so this second one here is why I think there's so few really famous, really successful fund managers and hedge fund managers, is because despite all this being true, they're still accountable to short-term returns. There was a period of time when people were saying that Warren Buffett was kind of washed up, like he couldn't do his thing anymore. Obviously that's changed now with everything happening through COVID, but sometimes it takes years for these returns to present itself. And when you're picking a company based on the company, even the investors themselves don't know when they'll be rewarded for that. And that's that saying from that we saw earlier, that in the short term the stock market is a voting machine, but in the long term it's a weighing machine. It can take a long time for that to be weighed correctly, right? And unfortunately, people don't wait around for a long time. Even fund manager companies, right? Like RBC Investments don't really care how their funds perform. They care as long as there is money coming into the funds and they get to make their management fee, but they don't really care beyond that. So what do they care about? Well, they care about making the fund attractive. So if suddenly the fund has been underperforming for 3 years, guess what? They're going to put a lot of pressure on the managers to step up your performance. And what does it mean? They might force them to doing things that is what everybody else is doing, and just buying the big tech names or buying this or buying that, which can be a mistake long term. But sometimes they just don't have the time to wait, which is where you have people like Warren Buffett and other Bill Ackman, all these other big investors that, like, if you're working with them, they don't want to hear anything from you type of hedge fund type managers, because you pay them to do a job and they're going to do the job, and they don't care what the short term valuation is, but they have the 20-30 years of evidence to prove that they know what they're doing. So vast majority of money managers don't have that type of luxury. So it's unfortunate, but that's just where they're at. And and then who haven't levered up with debt that might have to be repaid in short term. Basically, no short-term liabilities. So most investors lack some of these things, and few have them all. But to the extent these characteristics are present, investors should take advantage of their ability to withstand volatility. Since many investments with the potential for high returns might be susceptible to substantial fluctuations. Warren Buffett always put it best. On this topic, he usefully said, "We prefer a lumpy 15% return to a smooth 12% return." I wish you could get a smooth 12% return these days. Investors who would rather have the reverse, who finds a smooth 12% preferable to a lumpy 15, should ask themselves whether their aversion to volatility is mostly financial or mostly emotional. I don't really agree with the way this is written. It seems like it's like money is emotional. That's just the truth. And I think trying to hush that is maybe a little counterintuitive. I don't think it really works. I wish it worked, because it's obviously very easy if you could remove emotion from money. I just don't think it works in practice. So while I agree with it, I don't know. It just seems very. You should ask them whether they're rushed, because it doesn't seem very finger pointery, but it feels that way for some reason. Okay, anyway. Of course, the choices made by employees, investment committee members, and hired investment managers may have to reflect real-world considerations. People in charge of institutional portfolios can have valid reasons for avoiding ups and downs that their organizations or clients might be able to stomach in financial terms, but would still find unpleasant. All anyone can do is the best they can under their particular circumstances. But my bottom line is this: in many cases, people accord volatility far more important than they should. Yeah, I mean I think that goes without saying. That's and I guess that's just it. That's the consequence of investments like this being valuated every second of every day, is that you get that unpleasantness when you buy farmland. You don't see the days where it's down or the years when it's down, because it's only valuated once, and that's when you go to sell it. And even then, it's only valuated to people in a certain area that are looking for that certain piece of land, right? Like it's a lot less. There's a lot less volatility when it comes to even privately owned businesses. That you just don't see the volatility that public companies are subject to. So, an aside, while I'm on the subject of volatility, I want to turn to an area that hasn't reported much of late: private investment funds. Is this worth reading? Yeah, this is just talking about private equity and the way they're publishing returns to basically pander to investors, because they can pick when they write stuff off, right? You probably saw recently with the FTX going bankrupt. You probably saw in the news that like Ontario's pension of Canada, they had a chunk like barely anything invested in them compared to the overall size of the portfolio, but it was millions or billions of dollars, whatever. And they decide to write it all off, right? So when it comes to private equity, you have that discretion of when you, honestly, when you write something down. So here it's talking about them like in the first part of 2022, there were average gains of 1.6%, and then later on, then it was marked down afterwards. Yeah, I don't know. Anyway, doesn't really matter. Okay, what doesn't matter? Hyperactivity. In selling out, I express my strong view that most investors trade too much, since it's hard to take multiple consecutive decisions correctly to make, and trading costs money. Excuse me. Since it's hard to make multiple consecutive decisions correctly, and trading costs money, and it's often likely to result from an investor's emotional swings, it's better to do less of it. When I was a boy, there was a popular saying, "Don't just sit there, do something." But for investing, I'd invert it. Don't just do something, sit there. Yeah, it can seem like, oh, I should be doing something, but oftentimes it's best not to. How much more of this is left? Asymmetry. Okay, this is a little bit. We'll keep going. Okay, in selling out, I expressed my strong view that most investors trade too much. But since it's hard to make multiple consecutive decisions correctly, and trading costs money and is often likely to result from an investor's emotional swings, it's better to do less of it. When I was a boy, there was a popular saying, "Don't just sit there, do something." But for investing, I'll invert it. Don't just do something, sit there. Develop the mindset that you don't make money on what you buy and sell. You make money, hopefully, on what you hold. Think more, trade less. Make fewer, but more consequential trades. Over-diversification reduces the importance of each trade. Thus, it can allow investors to take actions without adequate investigation or great conviction. I think this makes me think. Most portfolios are over-diversified and over-traded. Clear distinction here, so he's talking to money managers themselves. I would say that the average retail investor, vast majority of retail investors do not have the time or the ability to go into as much detail as they would need to in order to make very few trades with great conviction. It's just as simple as that. It's a full-time job. So yeah, I think there's a strong case for over diversification. If you're trying to outperform the market, if you're not trying to outperform the market, then market minus fee type of return is pretty acceptable. But if you're really trying to outperform the market, you can't be trading in the market, right? Like if you're trying to outperform something, you can't just partake of it. So you have to view it as a very specific, you're buying a business, and that is, you're not trying to outperform every year, you're trying to outperform over 30 years, right? I think there's a strong case for it if you're going to be on that side of investing. Anyway, I devoted a good portion of The Illusion of Knowledge and Selling Out to warning investors about how difficult it is to improve returns through short-term market timing. And I quoted the great investor Bill Miller. "Time, not timing, is key to building wealth in the stock market." On this subject, I was recently asked by a consultant, if you don't try to get in and out of the market as appropriate, how do you earn your fees? My answer was that it's our job to assemble portfolios that will perform well over the long run, and market timing is unlikely to add to the outcome unless it can be done well, which I'm not convinced is usually the case. Usually the case? I've never seen somebody on a large scale do it. Like, the people that you hear about doing it well, first of all, you hear about one period of time where they traded well and they made a bunch of money, not about the 50 times after that they lost money and the 50 times after that they lost even more money. But timing the market is just like, you have to know two things. You have to know when to get out and when to get back in. And to do that consistently is it's the fool's errand. Anyway, what about you? I asked. If you help a client establish an appropriate asset allocation, does it follow that you're not earning your fees if you don't change it a month later? Fair enough. Likewise, the day The Illusion of Knowledge came out, an old friend asked me, "But you have to take a position on short-run events, don't you?" My answer predictably was no, not if you don't have an advantage when doing so. Why would you bet on the outcome of a coin toss, especially if it costs money to play? And this is what I was saying about the guy in 2008, right? Like, yes, it paid off, but a lot of his trades haven't paid off. it's just really risky to do. That's why, like, you don't make it is, and it's all about absolute risk. I'm not talking about volatility. I'm talking about absolute risk of something going really wrong. And if it doesn't drastically outweigh, if the upside doesn't drastically outweigh the downside, and if all the downside is beta is your portfolio dropping 20% and coming back up within a few years, like that's an easy thing to cost. That's an easy decision to make if you compare that to actually losing money and losing it on derivatives and whatever you're doing to try to offset the down that may or may not be coming. Like yeah, this cost to play is important. It's really important because theoretically a lot of things are possible. Even if you go back to a year ago in a review or an email I said that interest rates would probably come up, which means that we knew bond prices would drop. I released a video about bonds and everything like that. So why didn't you just sell the bonds? And it's like, supposed you're wrong, right? Like, what? I mean, if you're gonna sell them, you might as well play the other side, right, and short it. And like, I don't know, it's just for the risk, it just isn't worth the reward. So no, yeah, don't play. I'll end my discussion of this subject with a wonderful citation. A news item that has gotten a lot of attention recently concerned an internal performance review of Fidelity's accounts to determine which type of investors received the best returns between 2003 and 2013. The customer account audit revealed that the best investors were either dead or inactive. The people who switched jobs and forgot about an old 401k, it's like their RSPs type thing, like pension plan, leaving the current options in place, or the people who died and their assets were frozen while the estate handled the assets. Fidelity's the best investors are dead. Since the journalists have been unable to find the Fidelity study, and apparently so has Fidelity, the story is probably... What are with these words? What does that even mean? Oh, okay. Parable typing. It's probably not true. But I still like the idea, since the conclusion is so much in line with my thinking. That's a bias all on its own, but won't get into that. I'm not saying it's worth dying to improve investment performance, but it might be a good idea for investors to simulate that condition by sitting on their hands, doing nothing. What really matters is the performance of your holdings over the next 5 or 10 or more years or more, and how the value at the end of the period compares to the amount you invested and to your needs. Some people say the long run is a series of short runs, and if you get those right, you'll enjoy success in the long run. They might think the route to success consists of trading often in order to capitalize on relative value assessments, predictions regarding swings in popularity, and forecasts of macro events. I obviously do not. Forget what he obviously does. Like, the evidence is there. In fact, if you ever want to look it up, I looked it up recently. Spiva. It's a study that's done often comparing fund managers to the benchmark. But basically, it shows that most fund managers underperform the benchmark, and they do it persistently. And good performers aren't. Doesn't mean that they're going to continue that good performance. In fact, it's a very, very small percentage of them do. So again, it really, in large asset classes like U.S. equity, for instance, it really begs the question: is it worth doing? Is it worth paying somebody to try to beat the benchmark, or is it better just holding the benchmark and accepting benchmark minus fee returns if you can get it a lot cheaper? Which is what I do anyway. Where was I? I obviously do not. Most individual investors and anyone who understands the limitations regarding outperformance would probably be best off holding index funds over the long run. Investment professionals and others who feel they need or want to engage in active management might benefit from the following suggestions. I think most people would be more successful if they focused less on the short run or macro trends and instead worked hard to gain superior insight concerning the outlook for fundamentals over a multi-year periods in the future. They should study companies and securities, assessing things such as earning potential, buy the ones that can be purchased at attractive prices relative to their potential, hold on to them as long as the company's earnings outlook and the attractiveness of the price remain intact, and make changes only when those things can't be reconfirmed or when something better comes along. This is really important. So he's obviously an active manager, and I think for most people, the right route is passive management for a good chunk of the portfolio. But if you are going to do it, this is what it takes in order for it not to be gambling, for you to be, when you buy that company. And the reason I say that is buy the ones that can be purchased at attractive prices relative to their potential. So in order to be able to fulfill this statement, just one statement right here, there's a few things that need to be in place. First of all, you need to know what their potential is. And then you need to be able to convert that potential into their price. And then you need to determine whether their price right now is attractive compared to that potential. There's a lot of work that goes into figuring something like that out. To be truthful, to be honest, that's a lot of work. And then on top of that, you're trying to make sure that that potential is above and beyond what the market would give you anyway, because then it was all a waste of time and you should have just bought an index fund and got that return. So it's a tall order. It's a tall order to beat the market. And then you're doing this over multiple years. Like it's difficult to do. It's not saying it's impossible. Theoretically, it's very possible. People have done it. People do it. Just if I'm gonna roll the dice on my future on it, it isn't. If I go to a roulette table, I'm definitely not picking white. And that's pretty much what you're doing. Anyway, at the London conference mentioned on page 1, while I was discussing and discouraging paying attention to the short run, I said that the oak tree would consider it our job to buy debt that will be serviced as promised, or will return the same amount, or if not more. Excuse me. Invest in companies that will become more valuable over time. I'll stick with that. The above description of the investor's job is quite simple. Some may say simplistic. And it is. Setting out the goals and process in broad terms is easy. The hard part is executing better than most people. That's the only route to market-beating performance. Since average decision-making is reflected in security prices and produces average performance, superior results have to be based on superior insight. But I can't tell you how to do these things better than the average investor. There's a lot more to the process. I'm going to outline some of what I think are key elements to remember. You'll recognize recurring themes here from other memos and from earlier pages in this one, but I make no apology for dwelling on things that are important. Forget the short run. Only the long run matters. Think of securities as interests in companies, not trading cards. Decide whether you believe in market efficiency. If so, is your market sufficiently inefficient to permit outperformance? And are you up to the task of exploiting it? Decide whether your approach will lean more towards aggressiveness or defensiveness. Will you try to find more and bigger winners, or focus on avoiding losers, or both? Will you try to make more on the way up or lose less on the way down, or both? Hint, both is much harder to achieve than one or the other. Some would say next to impossible to achieve, but in general, people's investment styles should fit their personalities. Think about your normal risk posture should be, your normal balance between aggressiveness and defensiveness, based on your or your client's financial position, needs and aspirations, and ability to live with fluctuations. Consider whether you'll vary your balance depending on what happens in the market. Adopt a healthy attitude towards risk and toward return and risk. Understand that the more return potential, the better can be a dangerous rule to follow, given that increased return potential is usually accompanied by increased risk. On the other hand, completely avoiding risk usually leads to avoiding return as well. Yeah, I think this is really important. Some people, like I work with some people that are like, they're like, I'm very aggressive. I'm like a risk tolerant investor. I want the growthiest potential stuff. And sometimes it's just not worth it. Sometimes it's not worth it to take all that risk on for no reason. A really good example of that is like energy in Canada. Energy like did really well over the last year or whatever. That is so risky from a up and down point, from a volatility point of view. It's probably one of the most riskiest asset classes I can think of in Canada, and it's very bust or boom type investment. The fact is that over the last 10 years, I think the last time I checked, it is crazy low, the return. You'd been better off, I think, leaving it in like cash or something. Like it's bad. So you took all that risk, and there was just no return to it. So there is that side of it as well, that it's possible that you could take all the risk and just not have the return materialize. On the other hand, completely avoiding risk usually leads to avoiding return as well. Insist on an adequate margin of safety, or the ability to weather periods when things go less well than you expected. Stop trying to predict the macro. Study the micro like mad in order to know your subjects better than others. Study the micro like mad. Okay. That was an acronym. Understand that you can expect to succeed only if you have a knowledge advantage, and be realistic about whether you have it or not. Recognize that trying harder isn't enough. Accept my son Andrew's view that merely possessing readily available quantitative information regarding the present won't give you above average results, since everybody else has it. This feeds into the efficient market hypothesis. Recognize that psychology swings much more than fundamentals, and usually in the wrong direction or at the wrong time. Understand the importance of resisting those swings. Profit if you can by being counter-cyclical and contrarian. Buy when the streets are red. I think it's something that Warren Buffett said. It's true. It's really difficult to do though. When markets are down like they are now, to put it in and see your money go down further can be very difficult to do. But it works. It's worked throughout all of history. Has in fact never been a period of time when it hasn't worked. If you've had the time to wait. So take that what you will. Some would say if it's 100%, if it's worked 100% of the time, there's no risk in it. But I don't know whether I agree with that. But yeah, it's very true. Okay, study conditions in the investment environment, especially investor behavior, and consider where things stand in terms of the cycle. Understand that where the market stands in its cycle will strongly influence whether the odds are in or against your favor. Buy debt when you like the yield, not for trading purposes. In other words, don't buy 9% bonds if you think the yield compensates you for the risk, and you'll be happy with 9. In other words, buy 9% bonds if you think the yield compensates you for the risk, and you'll be happy with 9. Don't buy 9% bonds expecting to make 11% thanks to price appreciation resulting from declining interest rates. Ignoring the debt thing here, this is also true of real estate. As a real estate investor, the best real estate investors do not buy based on them thinking that the market is going to go up in that area. They buy because the return on the property is good and attractive, because the current rent that you can rent it out for makes sense compared to the price, not because they are hoping that the property doubles in value. Because surprise, that if you again look through history, people think of property as like this great investment, but in fact it hasn't been. Especially if you take out a few boom periods of time, like it's just most of the time it's not as good as what people think. Anyway, of critical importance, equity investors should make their primary goals: A, participating in the secular growth of companies, growth of economies and companies, and benefiting from the wonder of compounding. Think about the 10.5% yearly return of the S&P 500 index, or its predecessors, since 1926, and the fact that this would have turned $1 into over $13,000 by now, even though the period witnessed 16 recessions, one Great Depression, several wars, a world war, global pandemic, and many instances of geopolitical turmoil. Says it already. Think of participating in the long-term performance of the average as the main event, and their active efforts to improve on. Think of participating in the long-term performance of the average as the main event, and the active efforts to improve on it as embroidery around the edges. This might be the reverse of most active investors' attitudes. Improving results through over and underweighting, short-term trading, market timing, and other active measures isn't easy. Believing you can do these things successfully requires the assumption that you're smarter than a bunch of very smart people. Think twice before proceeding, as the requirements for success are high. See below. Don't mess it up by overtrading. Think of buying and selling as an expense item, not a profit center. I love the idea of the automated factory of the future, with its one man and one dog. The dog's job is to keep the man from touching the machinery, and the man's job is to feed the dog. Investors should find a way to keep their hands off their portfolios most of the time. It's something else advisors do. A special word in closing. Asymmetry. Asymmetry is a concept that I've been conscious of for decades and consider more important with every passing year. It's my word for the essence of investment excellence and a standard against which investors should be measured. First, some definitions. I'm going to talk below about whether an investor has alpha. Alpha is technically defined by return as return in excess of the benchmark return, but I prefer to think of it as a superior investing skill. It's the ability to find and exploit inefficiencies where they are present. Inefficiencies, mispricing or mistakes, represent instances when an asset's price diverges from its fair value. These divergences can show up as bargains or the opposite, overpricing. Bargains will dependably perform better than other investments over time after adjustment for their riskiness. Overpricing will do the opposite. Beta is an investor's or portfolio's relative volatility, also described as relative sensitivity or systematic risk. People who believe in the efficient market hypothesis think of a portfolio's return as the product of the market's return multiplied by the portfolio's beta. This is all it takes to explain results, since there's no mispricing to take advantage of in an efficient market, and so no such thing as alpha. Thus, alpha is skill that enables an investor to produce performance better than that which is explained purely by market return and beta. Another way to say this is that having alpha allows an investor to enjoy profit potential that is disproportionate to loss potential. Asymmetry. In my view, asymmetry is present when an investor can repeatedly do some or all of the following: make more money in good markets than he gives back in bad markets, have more winners than losers, make more money on his winnings than he loses on his losers, do well when his aggressive or defensive bias proves timely, but not badly when it doesn't. Do well when his sector or strategy is in favor, but not badly when it isn't. Construct portfolios so that most of the surprises are on the upside. For example, most of us have an inherent bias towards either aggressiveness or defensiveness. For this reason, it doesn't mean much if an aggressive investor outperforms in a good year or a defensive outperforms in a bad year. To determine whether they have alpha and produce asymmetry, we have to consider whether the aggressive investor is able to avoid the full loss that his aggressiveness alone would produce in a bad market, and whether the defensive investor can avoid missing out on too much of the gain when the market does well. In my opinion, excellence lies in asymmetry between their results in good and bad times. As I see it, if inefficiencies are present in the investor's market, she has alpha, and the impact will show up in asymmetrical returns. If her returns show no asymmetry, the investor doesn't have alpha, or perhaps there is no inefficiencies for her to identify. Flipping that over, if an investor doesn't have alpha, and her returns won't be asymmetrical. It's as simple as that. Basically, it's saying that the job of an active manager is to go up more is either one or two things: either to go up more in good times than the market does and down less in bad times than the market does, or go up less when the market does and go down less when the market goes down. So you're looking for pretty much. You're looking for people that that kind of can capture more of the upside and less of the downside, whether that's aggressive or defensive, and it's relative to their strategies, right? So you're comparing it to in this case, you're comparing it to other managers. So a manager's an ability to, if they're defensive, they should go down less in downtimes. Every defensive manager should go down less in downtimes. So you should be judging them by how much they go up in uptimes. Same for an aggressive manager. An aggressive manager should go up a lot during uptimes, but it's the downside that shows whether they're a good manager or not, because they should be going down less than their peers in downtimes, and that's where you get the relative outperformance. And when you actually look at fund managers that have done well and that you see really good track records, oftentimes it comes down to 1 year where they did better than the market in that respective category. There's been a multitude of fund managers that I've used, and that's what it all comes down to. It comes down to, like, they did really well in 2008, or they did really well in 2013. Like, whatever it is they outperformed the market significantly. Oftentimes it's on the downside in 1 year, and that sets them up to be, top 1% fund for the next 10, 15 years, all because of that 1 year that they managed to outperform the market significantly. So that's where a lot of times it comes down to. It comes down to that one year, and you take that year out, and they're very, very average. But that 1 year sets them apart from their peers. Anyway, to simplify, here's how I look at things here's how I think about asymmetry. The discussion is based on material I included in my book. While I may appear to be talking about one good year and one bad one, these observations can only be considered valid if their pattern holds over a meaningful number of years. Honestly, I don't care too much about fund manager performance until it's a full cycle. As a general rule, I do not use if I am going active, this client wants that, it makes sense for them. If they have not been managing money and I cannot see a track record through a full market cycle, so from recession to recession, you can't judge a manager's skill. It's just you can't do it. And people that greatly have crazy ups, I'm always terrified of. It's just not very scary to me. So don't touch them with don't go near any of them type of them funds. So there's part of the process, I guess. Okay. Only valid if these patterns hold over a meaningful number of years. Let's look at the manager's performance. So, so markets went up 10%, went down 10%, up 10%, down 10%. They hold no value. You might as well just bought an index fund. Pretty simple. Because remember, you can't invest directly into the index, so there's always going to be fees involved. So it's always, in this case, when we're talking about it, he's talking about performance minus fees, right? So if the manager was charging 2.5% is what it was costing versus 1% or 1.5% for the market, where it's better to have held the lower cost investment, or if you can do it yourself, you can get it even cheaper. These two managers also added no value. So they're talking about, so here we have the aggressive manager, and then we have the defensive manager. So they're saying, it was half, right? So they either half, they have a beta of 0.5 or beta of 2%. You could do this by just taking out a bunch of, using your money, taking out a bunch of debt, and putting it into the markets, and you'll double your return and double your losses, right? So it's as easy. It doesn't take skill to do that. It's as easy as willing to take the risk with leveraged money. Okay, well, there you go. In case of manager C doubling your, I should just read this, by doubling your investment and with borrowed capital and putting it all in an index fund. Yeah. Okay. These managers do have asymmetry. Okay, so we have the aggressive one and we have the defensive one. So what you'll see is what he's talking about is that when like you're looking for managers that can capture more, but it means that so they up 17%, then you'd expect to see a down 17% as well. But in this case, we don't see that. We see asymmetry. It's good. And then it talks. Okay, well, this is kind of impossible. But basically, he's saying that what you're looking for is somebody that that basically outperforms in both directions, because outperforming in one direction isn't a skill. So basically, if you're gonna select an active manager, he's saying obviously he's an active manager, so he has some stock in the game. But he's saying that this is what you should look for. So what matters most? Asymmetry. In summary, asymmetry shows up in a manager's ability to do very well when things go his way and not too bad when they don't. Yeah. A great adage says, never confuse brains and a bull market. Managers with the skill needed to produce asymmetry are special because they're able to fashion good gains from sources other than market advances. When you think about it, the active investment business is at its heart completely about asymmetry. If a manager's performance doesn't exceed what can be explained by market returns and his relative risk posture, which stems from his choice of market sector, tactics, and level of aggressiveness, he simply hasn't earned his fees. Without asymmetry, active management delivers no value and deserves no fees. Instead, all the choices an active manager makes will be up for naught if he doesn't possess superior skill or insight. By definition, average investors and below average investors don't have alpha and can't produce asymmetry. The big question is how to achieve asymmetry. Most of the things people focus on, the things I describe on page 1 through 9 as not mattering, can't provide it. As I've said before, the average of all investors thinking produces market prices and obviously average performance. Similar to I think 70% of people think they're above average drivers. It's just not possible, right? And the same with the markets. If everybody's participating, so likelihood you'll get average performance. Asymmetry can only be demonstrated by the relatively few people with superior skill and insight. The key lies in finding them. That's where it comes down to, is finding these people, and it's and that's when you really have to ask yourself the question: is it worth it to try to find them and be wrong, right? Because there's been tons and tons of research, and there's no way to tell beforehand, right? Like, hindsight is obviously great. I can put up a list of the best performing funds over the past 15 years, and it's like, yeah, we'll pick those ones then. But there's also tons of evidence showing that the next 15 years, they're very, very unlikely to outperform again. So it does come down to the question of whether it's worth taking that risk. But anyway, this was a long one. This was really long. So hopefully you learned something from it. It was an interesting read. I'll leave the link in the notes in the comment section if you want to check it out. They release stuff every single year. Maybe this was just a little bit of an insight into the type of stuff that I read. Although this took me a lot longer to read like this than it does normally. But anyway, I'll catch you in the next one, I guess.